All right. Hey, everyone. It's Investment Tuesday. And today we have a jam-packed Investment Tuesday with three investments. One of them is a crypto that just like, I don't know, like when I look at the charts, when I look at the news, when I look at what is going on in the world, they are screaming out to me that they want to go higher. And not just a little bit higher, like insanely higher, like big time higher. I'll say 100% surge by year end. That's right. I'm putting myself out on a limb, 100% by year end. So, we are almost at the midway point of 2025. It has been an interesting year, to say the least. And it is, I think, going to get more interesting as the second half of this year unfolds. And so, for the coming second half of this year, three investment, two stocks, and one crypto that everything is just telling me these things want to go. They want to go. In other words, I think there's people buying, and the mainstream of investment thinking is all upside down on this. Yeah, what to do? I mean, that's what creates opportunities, right? I mean, some people believe something, and that gets put out in the media, and then instead you look at it and you go, no, 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 it's the other. This is about to go up, and it's about to go up a lot. So I'm going to put these three investments in front of you. But before I do that, and before I even get to the legal disclaimers and disclosures, I want to shout out to our team. We are launched our options course by popular demand. In fact, the most demanded questions that we have on a regular basis at ATG is, teach us about options. Tell us what these call things are. Tell us what these put things are. What is going on? Teach us, show us. And we have answered your call. We have created an incredible, awesome options course for you, and it is available right now. So go to atgdigital.media and check out our options course today. Do it. We have had some incredible winners. We've got some huge open trades, including on one of the investments that I mentioned where we're up 300%. So, give you a reason to stick around for this YouTube video, but go check out our options course. It's amazing. And, it's in typical ATG style. We won't give you that the technical jargon of like, delta, schmalta, and all this. We just keep it simple, which is like, hey, this thing goes up. Here's why, right? We try to keep it simple, right? Okay. Now let's feed the hungry lawyers with our legal disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, our opinion, ATG's opinion. You use it as information. You use it as engagement. Use it as entertainment. Go ahead and laugh. I know some people find me hilarious, but that's good, right? I mean, it's all right. Okay. But whatever you choose to do with it, it's your responsibility because it is your money. Okay. All ATG digital content may contain errors, oversights, and mistakes. In other words, just because I'm talking about it doesn't guarantee that everything is perfect. Yeah. Please understand that investment operations, buying or selling a stock, option, crypto, have significant risk and can lead to the loss of your principal. You may lose money. You need to be aware of that. Next, the owners, employees, contractors of ATG Digital, we own, we trade, we transact in the securities that I mentioned in this video and all of the content from ATG Digital. We do not take money from managements of companies. A lot of like microcap stocks, etc. They will pay you to recommend their stocks. We don't take money from them. We are offered all the time. Same thing with crypto promoters, sponsors. They also will pay you. We don't do any of that. So for better and for worse, for gain and for loss, we are independent. We are, whatever you get is our unique point of view. This is all of the content we put out, our Substack, the Podball Man Speculating Podcast, the YouTubes that go out every week. We got me, we got Dean, we got Dan, we've got the super team on social media, most active on X, next Facebook, and then Instagram. Follow us, check us out, always worthwhile. Finally, subscriptions to trades, information, updates at atgdigital.media at starting at $9.99. I will leave that ticker to run. Okay, this week's Investment Tuesday is about 3 investments that I think really fit the current time. It's just what? Number one, we have this tension that is there in markets, which is partly driven by, the whole, thing about trade, which is going to come to some sort of, it's not going to come to a resolution even this year, but we'll have some answers. In other words, come July 8th, how many trade deals will we have done with how many countries? And then in August, the big kahuna, the big one, China. Will we have a deal with China? If so, what kind of deal? And what will, happen as it unfolds? If you watch my other videos, I've told you what I think is going to unfold with respect to the overall markets. And I know many people will be bullish, they'll be bearish. And truth is that I don't really think that this is like a huge mover of things one way or the other. I think that one of the natures of today's markets is that it's really investment specific. It's stock specific. This is a stock pickers or investment pickers market. You got to be in the right thing, in the right time, and you have to have your ear out to the ground. And what is going on in the world? Well, we've got the trade war. We now have between 2 and 3 wars going on for real. We've got Russia, Ukraine. We have Iran, Israel. We also have India and Pakistan, which is, gone back in the background, but it's burbling there, right? I mean, it's still out there. So we got that going on, and then we've got this major issue, which it's deafening the silence, which is like, how will the central banks of the world and the governments of the world deal with the extraordinary amount of bond issuance that they all need to keep themselves in business? I did my video about the bond market. I don't know if it'll be a crash. It'll be something. Maybe it'll be a crisis. Maybe it'll be a crash, or whatever it is. But we between the United States, Europe, Japan, and China, we need $18 trillion to show up to buy bonds issued by these governments. Who will do this at current rates? Do you want to buy a 30-year bond from the U.S. government at what, 4.5%? Let me just put that up before I get into the 3 investments. Let me put up what the bond. Let's put up what the bond market yields are. I know most people are not very excited by bond market yields, but trust me on this. Come year end, you will care. You will care. This will matter, right? Okay. So most people don't pay attention to this. They was like, Paul, but the stock market's going up today. Just give us some micro cap stocks that are just going to shoot to the moon tomorrow. Listen, folks, the bond market. This is important. All right. You'll see the 30-year bond gives you a little under 5%. The 10-year bond gives you 4.44%. The 5-year 4%, and short-term yields, which is essentially 30 to 90 days, is 4.2. What you'll see is that's pretty compressed, right? I mean, you got, if you put your money into a 30-day or 90-day treasury bill, in other words, you get your money back in 30 days or 90 days, you're getting 4.2%. Or you can, throw your money at the government for 30 years and get 4.9%. Yeah, I'm thinking that 4.9% just ain't enough, right? 4.9% just ain't enough. It says 4.9 by itself is not the bad number. It's the fact that I could get 4.2% by just, I could give it to the government. They give it back at the end of 30 days. I could buy it again. What's the benefit of that? Well, if interest rates go up, in 30 days, yeah, I get the benefit of that, right? So, I don't have to take, that much risk, because if interest rates go up and the 30-year bond, as I have theorized, might go to whatever, 5.5, 6, maybe 6.5%. Yeah, you lose a lot of money. Why? Well, because, hey, you obviously bought a bad deal at 4.9%, 5%. You gave your money to the government for 30 years. And now, whatever, 1 month later, 2 months later, yeah, they're like, oh yeah, well, we'll give you 6.5% if you lend it to us for 30 years. So obviously all the bonds that were sold, with a yield of 4.95%, those are losers. And so the price of all those things go down. All right. Now, I'm bringing all this up because there is no way in my mind that the governments of the United States, the European Union, Japan, China, which are the world's major economies, yeah, they all have, yields that look like this. In other words, those 10 and 30-year yields simply are too low, in my judgment, in my opinion. And I believe by year end, I'll stick my neck out and say by year end, we will see some dramatic price action in the bond market on the long side. And it is going to have some twists. It's going to have some twists, right? Which is why, I'm not a believer in a crash scenario. I think there's going to be some significant volatility. I'll just put it out there, right? But I don't think this is going to be a scenario where, like, everything goes down. I think some things go down, like things that have a lot of debt that might be affected by very high long-term interest rates. Those things will go down, and other things like gold, will jump and rocket higher. Like Bitcoin will rocket higher. Other investments where one of the themes that I've been talking about is that have current cash flows, that have predictable cash flows, that have pricing power. Those will all rocket higher. So this is not going to be a one-size-fits-all scenario, but I expect that come year end, we will have gone through a period where 30-year bond will have jumped higher, 10-year bond will have jumped higher. And this is the key, you see. As that happens, there is going to be a lockup in credit markets. There is going to be some distress. Yes, there will be volatility. There will be a little panic. But what will it do? Well, what it will do is it will make the Federal Reserve cut interest rates, short-term interest rates. All right. So that's short-term yields, which are now at 4.2%. You see that down here. All right. 4.2%. They will cut those. But just understand that, like, that, is a very different kind of cut than what everybody thinks, is going to happen, because that cut is coming because these numbers here are shooting higher to 5.5, 6%. In other words, this goes down as this goes up. All right. So what you have is going to be a very steep yield curve. Right now, we have a pretty compressed yield curve, right? The difference between what you will get in interest rates for lending the government money for 30 days and 30 years is 0.7%. It's almost laughable, right? That would only really be, a proper rate if we were like, what we were, 10 years ago, which is like we'd had a great financial crisis and people don't want to spend money, and there's the threat of deflation. That's not the scenario we have now. We have a scenario where inflation is not like rocketing higher like it was in 2021 and 22 at 6 and 7 and 8 and 9%, but it is persistently above 2%. Persistently above 2%. Next, in that scenario, it was completely, there were plenty of people willing to buy 5-year bonds, 10-year bonds for 3 and 4%. We just don't really have that anymore. And the reason was that we had this huge jump in money issuance over COVID. We had inflation. Now you can add on, the incredible spending that we've also had in the United States. In other words, it's a different world. It's a different world. And to get 18 trillion funded by the world's major economies, in my opinion, is going to take some lifting of long-term bonds, right? I mean, to get a bunch of 30-year bonds sold, in the, let's say, hundreds of billions of dollars, they're going to have to pay up. And as that happens, the yield curve will go like this, and that will benefit a completely different set of investments than what benefited, from interest rate cuts from 2009 to 2021, when every time the Fed cut, speculative stocks rocketed higher. In this scenario, with a steep yield curve, it is cyclical stocks, it is small cap stocks, it's value stocks that really benefit. And the reason is that a steep yield curve means that the economy is going to run hot. You could see crazy high GDP numbers of 5 and 6%. Inflation will run hot. And in that scenario, you will find growth everywhere, right? And so people be like, why do I need to pay 30 times sales and 25 times earnings for something that is growing at 12% when I can get 12% for 4 times sales and 2 times earnings? Yeah, I'm going to sell the expensive thing and I'm going to buy the cheap thing. So that's the scenario under which, I think we're going to come under in 2025. And that will sort of really change, how people think and approach the markets from 2025 on. All right. And one of the places that, you'll see just money push into, because in this scenario, people will be like, okay, I can't really own the S&P 500. People think that this is a lock to generate 12% a year, sort of like an annuity or like a savings account. Yeah, no, I don't think so. That's not going to happen. All right. So people will start to push out, and you will have to go and find investments that have some unique properties, that have something different, that the vast majority of investors are not in, haven't thought about, or else even if they are in the sort of water and disgust, for whatever reason, they don't like them, they disagree with them. And that's when we get to the 3 investments that I think, given all this scenario, right? And I'm not saying that these will go just straight up. There will be volatility, all right? I tell you that right up front. And if you don't want to sit through volatility and you see these positions at losses at various different times, because these will go up and they will go down, don't complain. I have warned you. I have warned you ahead of time. The way to go about this is to have small positions and to be prepared for what I believe is going to be a rewarding but volatile period. All right. With that, let's go to investment number 1. It is the somewhat hated Tesla. Hated. Yeah, I mean, Tesla's kind of hated. Yeah, I mean, it doesn't really have a political home anymore. It used to be sort of like a stock that, people who were into the environment and the mission of sustainable energy bought. And then when Elon supported Trump, that sort of disconnected that part from Tesla. And then, there was the beginnings of maybe, a more conservative support for Tesla, but that's now also under the, Trump, Elon brouhaha, that's gone. So, it doesn't really fit anything. There's no real love for Tesla, right, in the market. However, Tesla has some business properties that matter, right? That is going to benefit, which is what? Well, in the scenario that I talked about, which is a steep yield curve, huge nominal economic growth, right? They have pricing power, right? They in that scenario, like where cyclical stocks like General Motors and Ford, they would all benefit, but Tesla can undercut all of them by cutting prices. Right? Remember, right? I mean, they already have kind of like the cheapest cars in their class with the Model 3, with the Model Y. They also have, importantly, right? They also have cars with the highest level of domestic content. Tesla cars have 70 to 75% of their content that originates in the United States. So even their supply chain of smaller parts, a lot of those are now made in the United States. So that gives them two levels of pricing power. One is the fact that the cost of batteries, which is one of the most biggest costs for Tesla, is going down like this. That means they can either hold price or cut price and undercut GM and Ford or any foreign manufacturer. Second, by having 70% versus 25 or 30, like Ford and GM have between their supply chain and actual manufacturing, a lot of their cars are manufactured in Mexico, right? So they got to pay tariffs. They got to pay tariffs. So Tesla can undercut them. And despite whatever everyone thinks about Elon and his politics, I can tell you when the price is right, people will show up and buy Teslas. And that will rocket the stock higher because at this point, nobody is really thinking that this can happen. So that is investment stock number one. Stock number one, Tesla. Now let's just look at what Tesla stock looks like on our chart. I know we have a lot of technical folks out there. Yeah, this is over 1 year. And just I like to look over 5 years. And essentially what you see is a band between about 415 and 100. Yeah, that's Tesla for you, right? I mean, it is volatile, 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 volatile. But my best guess is that in a shocking turn of events, yeah, we're going to get to $500-600, which would be approximately like a double from 300. I mean, okay, it's rallied up, over the last couple of days, essentially from like what, under 300. So let's just say 300 to 600 is the move that I anticipate as people understand that Tesla benefits from a rising economy, benefits from having pricing power, and benefits from having huge domestic content in its cars. All right. So that is investment number one. Second is the controversial Fannie Mae. Fannie Mae, which is now back to $10 approximately. There continues to be debate, controversy, discussion, argument all over social media as to whether or not Fannie Mae and Freddie Mac, I mean, these two sort of like will trade together, but I'm going to focus on Fannie Mae, whether they are going to be released from their conservatorship. This conservatorship has gone on for 2008, 17 years. I mean, September will be 17 years. I mean, wow. Yeah. There's like a 17-year-old person, yeah, that has never known a Fannie Mae that has just traded on the New York Stock Exchange, which is what, they traded where they traded prior to their conservatorship. I'm not going to get into the nuts and bolts of conservatorships. I have multiple videos on this channel from 2-3 years ago talking about this opportunity. I also have a really timely video right before the election in October talking about, Fannie Mae when the stock was about $1. So, hey, I think, I've earned some rights to have an opinion on Fannie Mae. My view is this, right? I'm going to go back to the macro scenario I laid out, right? Remember, long-term interest rates blow out, short-term interest rates go down. In that scenario, as it currently stands, mortgage rates are already at 7%. Let's assume that I'm correct, right? And we get the 30-year bond blows out to, let's say, 6%. As it stands now, the mortgage rates would probably jump by another percent and a half. Can you imagine? 8.5. Let's say worst case scenario, in like some sort of a panic, it's at 10%. We need somebody to go and buy all of the mortgage-backed securities that are out there, right? I mean, because the Federal Reserve is selling mortgage-backed securities, and they have been doing so quite aggressively for essentially 3-4 years, and they have no plans to go back and intervene in the mortgage market to push interest rates down like they did after the global financial crisis between 2009 and 2020. Instead, what they want to do is they've got, I don't know how much they have. They have $1 trillion worth of mortgage-backed securities, and they just want them gone. So they are not going to buy mortgage-backed securities to push them down as this unfolds, which means the Trump administration, the US government, needs Fannie Mae and it needs Freddie Mac, its brother, its sister, to go back to doing what they used to do before conservatorship, which is that they essentially provided yield curve control for the mortgage-backed market by buying mortgage-backed securities when the market didn't want them. In other words, if the market panicked about whatever, foreclosure rates, or any of the things that, the housing market panicked and they said, we don't want any mortgage-backed securities, we want to sell everything, Fannie Mae and Freddie Mac would buy them. And then when the market got becalmed, they would sell them. And the way they finance themselves is that they would sell bonds to the market to fund the purchase of these bonds. And the Trump administration and the US government, they, in a world where the US government needs $8 trillion worth of funding, the Federal Reserve is selling mortgage-backed securities. They need Fannie Mae and Freddie Mac to go back to doing what they used to do. And for that, they're going to need to be released from conservatorship. They need to be unleashed into the wild. And as that happens, the thing that I have dreamt, theorized, predicted for a long time now, all right? This is a 5-year chart. Well, let's do a 20-year chart, which is weekly, which is that this reverse waterfall, right? This is the waterfall down, right? Where Fannie Mae goes in April of 2008, it's at, in April, it's about, the high is 35. And by the end of 2008, it's at 30 cents. That is a waterfall decline. And I have said that we could see a reverse waterfall back to, I'll say at first 30, and then, I'm sure there will be some people that will be like, I've made plenty of money, I'm out, and they'll push it back down. But eventually it gets back to something like this. Why? Well, the mortgage-backed market is huge. The Fannie Mae and Freddie Mac are going to need large equity positions to be able to go and play the parts that they did. And I don't know exactly how this will pan out. Nobody knew exactly in 2007 and 2008 that the federal government would invent this thing called conservatorship that nobody had ever heard about. We knew about bankruptcy, but however, because these companies were seen as being so critical to the financial system, so critical to the economy, the government pulled out, I don't know, from somewhere, this conservatorship. Nobody had ever heard of it. They created it out of thin air, and then dumped them into it. So how they'll exactly come out of it, I don't actually have every single detail. The Trump administration has not committed to, exactly how they're going to do it. However, President Trump has been good for his word. He said he's going to release them, and I believe him. I think these are going to be released. And I believe that this will happen before year end. And as that happens, we will go from, I'll say, on the low side, $20, $25, to the high side, $30, $35, as we go back to valuing Fannie Mae and Freddie Mac based on their revenues, based on their sales, based on their free cash flows, and based on their future cash flows, right? And if they are going to be the buyer of last resort of mortgage-backed securities, their earnings numbers are going to be way higher than they are right now. All right. So that would be my investment number two. And it fits the theme that we're just like, yeah, I mean, the scenario under which these are set free, Fannie Mae and Freddie Mac are set free, are triggered to some extent by this bond market restructuring shift that I believe is going to unfold by year end, because the governments of the world almost all together all need money, and they all need vast amounts of money, and they can't all just sell treasury bills. In other words, they can't sell short-term, bonds for 30 days and 90 days, because then, this will eventually snowball into a bigger crisis. They got to sell some long-term bonds. The US government needs to sell a decent number of 30-year bonds, decent number of 10-year bonds. And that means somewhere between here and year end, you are going to see the 30-year bond blow out to, I don't know, 5.5% on the low side. I'd said 6.5% on the high side. And you can kind of like do the math from there. On the 10-year bond, we're at 4.5% the 10-year bond. So let's say 5.5%. And with that, you will see all kinds of movements as all asset markets start to reprice for this, right? And one of the repricings, if you will be Fannie Mae and Freddie Mac. In my opinion, my judgment, right? Not a guarantee. Nothing in life is guaranteed. Nothing in life is guaranteed. Finally, I'm going to throw this one out there. This is probably the most controversial call, and it is another sort of like hated investment. I do not think you can find too many people that are bullish on Ethereum. Why? Well, when you look at this chart, look at this 5-year chart, right? This 5-year chart, which is what? It's gone nowhere. It has gone nowhere for a long time. Look at this. I mean, the high in 2021 was 4,865. Me and everyone else were dreaming of 10,000 and 20,000 back then. Instead, we got lows of $883, and then a test here of 1,000, and then just in April, another test all the way to 1,400, right? So why? What is going to make people come and bid Ethereum higher? Well, if you go and look at Ethereum's inflation rate, it is actually flat. The amount of emissions or the amount of issuance of Ethereum is now down to essentially negligible. Let's say between 0 and 1% is what I've seen. The amount that's being staked has hit all-time highs at 30%. At 30%. Money is also flooding into the Ethereum ETF. And this one is a little bit speculative, but nonetheless, in the scenario where you've got, the US government bond market in some level of instability, chaos, crisis, whatever, the DeFi world of Ethereum becomes a legitimate alternative for many kinds of activities. And, that will drive activity in everything from Uniswap to Aave to Maker to so many of the decentralized finance platforms and tokens, which all sit on Ethereum. So this is all huge activity that's there. Something like a repricing of the bond market reprices pretty much all of the asset markets. And what it also does, it will make people go and look at financing rates on DeFi and be like, wait a second, that is cheaper than what I can get in the traditional finance or TradFi world. And people will go and start to use all of these platforms, which will send huge waves of volume onto Ethereum. Stable coins are just sort of like the first, like sort of like indication signal that people are looking for alternatives to the traditional finance system. The stock I mentioned last week, which is Circle, let me put this up there, is now $156 and has a market capitalization of $34 billion. Right? I mean, that is telling you that investors, speculators, traders are all looking at the current world. And while a lot of people are thinking like, oh, Fed cut, everything goes up, just buy, NVIDIA. Yeah, all these little signals are telling you a different world is coming. And I believe it is going to take, Tesla, Fannie Mae, and Ethereum higher. So that's my view. That's my opinion. And that is all I got for this Investment Tuesday. Another reminder to check out our options course, which is launched. That is in response to popular demand that we provide more education, more information for people to understand options. We have our platinum tier where we trade using both calls and puts. So check out ATG Digital's options course. And with that, that's it. That's it. 3 investments set to surge in 2025 as bond market, I don't know, chaos, instability, issues, crises, something really reset the world. All right. Thanks all for listening. It's Paul saying thank you and goodbye.